Coming up in today's show, stocks finished the week on a bearish note. I look at some IPOs, some bullish and bearish research. Oil continues ripping higher, and some technical analysis of what might have changed in the market. Hey, what's up guys? Happy Friday, Saturday or Sunday, wherever you are in the world. Welcome back to the Click Capital Daily Market Show. My name's Jared. I'm going to get you all up to scratch on the most important news, data and charts from the markets today, and let you know where I think the opportunities and risks may lie. And as we can see on the heat map here, there's a bit of a sea of red to finish out the week. That was led by semiconductors and software stocks as a whole, finishing down pretty hard, along with some consumer retail and even recent strong performer energy stocks have come off today, and we continue to see a little bit more of a defensive rotation, and we can see that in some of the healthcare stocks holding up the best out of the whole market. So stick with me today. I've got a good one for you. I'm going to dive into some technical analysis in a bit and go over some price action, as I think the market may be changing its tune here a little bit. But before we get stuck into that, let me give you one last and quick final reminder that my special offer to get all 22 of my custom indicators for TradingView closes midnight on Sunday Eastern Standard Time. That's New York time. So it's just a little over 2 days remaining to get more than 50% off all my custom indicators. And I promise you I won't ever sell them for this cheap again. $237 one-time fee, no ongoing costs or upsells from me. And so if you've been thinking about getting these indicators, I strongly recommend you give them a chance, because I do offer a 7-day money-back guarantee. So if you decide they're not for you, no problems at all. Just send us an email and we'll issue you a refund. So all the risk is on us, and you can test out all these indicators and see whether they suit your trading and investing. And I use my own indicators exclusively to run all my own portfolios and for clients as well, including my only bears strategy on the Collective 2 marketplace. And we just finished today at a new all-time high and currently up 25.3% for the year. Now taking it into the top 4% of all strategies on the marketplace. And I just wanted to give you an example today of a trade I just closed for subscribers today. And that was a short I took in Pure Cycle Technologies on the 5th of July. And I shorted it at $11 a share. And I just covered my short today at $6.30. Giving my subscribers a big 42% gain in a little over 2 months. And let me just go over my thought process of how I got in and out of that trade for you, just to kind of understand how I do it. So here we are on my fundamental chart. And you can see my custom indicators, stock fair value and business quality score. And so back in early July, when I was trading at $11 a share, you can see my stock fair value indicator had it at $4.69. So that was more than 100% overvalued. And that's generally what I look for in stocks to short, is that they're more than 100% overvalued compared to my stock fair value indicator. And you can see it also had a negative business quality score. And then just looking at my technical indicators, you can see the price went above my buy-sell band, and it was starting to peak out on the DSI, which was also in overbought territory. And just taking you out to a weekly chart, that's an area of resistance as well, where price had stalled previously. And this is kind of what I'm looking for in all trades. I'm looking for a confluence of multiple factors, both technical and fundamental, to give me the conviction to pull the trigger on taking a short. And so I shorted it at $11 a share, and here we are today down in the low sixes. And you can see, even though it's still a little bit above fair value, which is at $4.69, I normally like to cover my stocks when they get close to fair value. And on this trade, I've already gotten most of the meat off the bone, and I've been watching it the last couple of days, and you can see here it's really technically oversold. On my DSI's minus 19. My reversal signals are starting to fire off. You can see here on these green arrows, and the whole candle's below the bottom of the buy-sell band and the wave flow indicator. So we're really technically oversold here. Doesn't mean it can't go lower, but I just saw this as a good opportunity to cover the short for my clients and myself in this hedge portfolio. And since I always carry 20 short positions in this portfolio, I replaced it today with Celsius Holdings. A lot of you are probably familiar with that and their drinks. They are quite popular and they have been growing. However, I think the company is significantly overvalued, because my stock fair value indicator has it at $79 a share, and it's got a negative business quality score of minus 7.6 as well. And technically speaking, we put in a bit of a bearish engulfing candle here on heavy volume today, and I can see some bearish divergences forming on my DSI and hidden divergence indicators as well, along with those reversal signals which fired off last week. And again, I'm not saying this is definitely the top on the stock. This is what I just see as a good risk reward setup for a short here as part of a diversified portfolio of short positions for my clients. And again, I'll be looking to cover this one if we get back down closer to fair value, along with some signs that it's technically oversold. So that's pretty much how I run the Only Bears portfolio, and it seems to be working well so far. It's up 31.7% since December, and you can see the S&P 500 here in this light blue line, And so the strategy is already crushing the index. And just looking at a clean monthly chart of the S&P 500, you can see we haven't even had a real correction at all this year. So I can imagine when the market does inevitably correct, possibly crash, go into a new bear market, that my only bears strategy is absolutely going to crush it. And really my goal for this strategy and my subscribers is to deliver 100% return by the end of next year and double my subscribers' money. And again, I do all that using just my custom indicators. So if you haven't already, click the link below this video in the description and you'll come to this page and you can learn more about it. You can watch the video of me going over all the indicators in detail. And like I said, I offer a 7-day money back guarantee, so you're welcome to test it out. And if they're not for you, no worries at all. I'll send you your money back. However, like I said, I promise I won't sell them for this cheap ever again. Come Sunday night, they'll be back to $497. Okay, moving on through today's news. And yesterday we saw the biggest IPO come onto the market in quite a while. That's British chip maker ARM, and had a really good day yesterday, finished up over 24%. However, it has come onto the market at an already rich valuation, over 20 price to sales. And just looking at the price action we got in it today, we did gap up huge to $68 a share. However, we put in a huge dark cloud cover candlestick formation because we've finished below yesterday's close, down 4.47% today at just above $60 a share. And so normally a new big long-awaited IPO to the market can help the market get excited and improve sentiment. And we've also got another big one coming to the market next week, and that's Instacart. And they're a digital grocery delivery service, so you can sit at home and order your groceries, and it's kind of like an Uber Eats. Someone will go and get them all for you and bring them to you. And Instacart's priced their shares between $28 and $30. Plans to offer 22 million shares with a valuation of around $10 billion. That's going to trade under the ticker CART. And I'll be covering that on Tuesday afternoon when it should be just launched onto the market. And we'll see how the market responds to that. Because this is another one that's been talked about and people have been waiting for a while. And we're just going to see whether that can help get the NASDAQ and sentiment going, or whether it's a bit of a nothing burger. And staying with some bullish analysis is research analyst David Rosenberg, saying the NASDAQ could see a year-end rally despite weakness in coming weeks. He said their primary medium-term momentum indicator has been in a downtrend since late July, and that suggests that broad-based momentum pressures are on pace to continue into November. However, he's arguing that the NASDAQ still has long-term momentum and that the market's likely to find good support, and it'll be coming back up to a peak sometime in December or January. And that could be true. Just looking at a clean long-term monthly chart of the NASDAQ ETF Triple Q, we are now in a period of seasonal weakness around the September-October mark, when the market can typically take a breather and have a little bit of a pullback. And then we go into that seasonally bullish period going into Christmas and the early New Year. And one could argue that the market is still in this secular bull market from March 2009. And what we saw last year could merely have just been a correction in that bull market and not even a true bear market. And then we could go on to crazier and more richly valued heights in the stock market. And like I always say, anything is possible in the market. That's why we have to follow the price action first and foremost, because quite often price leads and fundamentals follow. However, it is hard to ignore the long list of bad fundamentals out there. However, that all depends on who you ask, because we've still got people like the Chief Investment Officer of Wealth Management at Goldman Sachs, Sharman Mosavar Rama, still saying the S&P 500 is your best bet. She's lowered the probability of a US recession to 30 to 40% for the next 12 months. She sees inflation continuing to head lower. She said if the Fed does lift rates again, that would increase the odds of a recession later next year. She's actually been bearish on China since 2013, and because of that, she still thinks the US will be the exceptional performer, and she's even making recommendations to MLPs, that's Master Limited Partnerships, which is true, there are some really high yields in that space, and she also recommends high quality securities to hedge against a deflationary environment or geopolitical shock. And there could be some signs that China's stimulus measures are already working, with their retail sales and industrial production growing in August, beating expectations, and their output of key commodities also increased. However, being China data, you always got to take it with a large grain of salt and look to the price action in markets for the truth, because there is a large elite class in China with close connections to the government that have really good insight into what's really going on. And if that economic data were true and things were really turning around in China, then why did the market sell off so hard in their Friday session, down 1.58%? On volume, coming back down to this bear market lows that they've been in for over a couple of years now. And another factor in the markets that could be a headwind or a tailwind for the stock market is the amount of funds flowing into money market funds. And that's on pace for a record 1.5 trillion going into that this year, as you can see by this chart here. And the bulls will argue that that's a lot of dry powder on the sidelines that could come into the stock market and get things going, and it's true. That's typically been the case in the last 20 years. However, the difference this time is those funds are earning above 5%. And overall, the stock market with a PE around 25, that implies an earnings yield of 4%. So all that money going into money market funds could be going into stocks. However, it's going into the safety of money markets and earning more than 5%. So that's a lot of competition stocks have got for that money. And for that to really change, one or two things has to happen. The stock market has to have a big correction, in which case it would then yield more than that. Or interest rates have to have a big correction, in which case current day earning yields on stocks would earn more. Or we could get a combination thereof. However, like my new optimal stock bond allocation indicator suggests, now is a good time to be allocating more to bonds than stocks. It's recommending 57.2% in bonds versus 42.7% in stocks. And that's the largest gap between bonds over stocks since 2007, just before the GFC. And since then, it recommended a much higher allocation to stocks, and was right, especially after the COVID dip, when it recommended 86% of a portfolio should be weighted in stocks. However, with the increased stock market valuation and those contracting earnings for the third consecutive quarter, and the rise in rates, the stock market is now clearly overvalued relative to bonds. Also adding pressure to the consumer is a housing market that's never been this expensive, with the median monthly mortgage payment hitting an all-time high of $2,632 in the 4 weeks up to September 10, and mortgage rates hovering near 2-decade highs. What's really helping the housing market in the US at least is most people are locked into lower rates than that and wanting to stay put, and that's what's choking supply in the market and helping keep prices somewhat elevated. However, there's going to be a lot of refinancing over the next couple of years, and that could change things a bit. And we can see that on this chart here, with the difference between the cost to buy and the cost to rent at a record high gap. And looking back in history, that inevitably converges back to the mean after it diverges away. And so that's likely to happen over the next couple of years as well, and could very well see some weakness in home prices, which are pretty elevated in Western developed nations all around the world. Also out today is everybody's favorite billionaire, Ken Griffin, CEO of Sidel, saying he's feeling anxious about this year's rally, and he's warning the impact of higher interest rates will soon be felt and could hit a lot of people really hard. He said obviously one of the big drivers of this rally has been the frenzy over generative AI, which has powered many big tech stocks. I like to believe that this rally has legs, but I'm a bit anxious we're in the 7th or 8th inning of this rally. And he said now we're at a point where we're going to see the impact of these rate hikes really start to play out, and we're starting to see the job market weaken. In addition to that, we have a huge corporate refinancing wall coming up next year, just like Mohammed El-Erian is warning us of. And this is at a time when rates have been trending up, and there's a lot of issuance going on out there from the government as well, selling a lot of bonds to top up the treasury. And that big $1 trillion refinancing wall hasn't even been hit yet, but we're already seeing a bit of a surge in corporate bankruptcies, already heading for the worst year since 2010, and we can see that in this chart here, showing just in the year to date through August, 459 large corporations filed for bankruptcy protection, and a lot of that is due to them just simply not being able to pay their debt back and just having no liquidity, and financiers that have just lost confidence in them and have basically just turned off the tap. And so the Fed and a lot of corporates are hoping rates can come down next year. They really want that to happen so they can refinance again at a low rate, keep the party going. However, counteracting that desire is oil on the march higher and really in a strong technical uptrend now, on the back of production cuts from Saudi Arabia and Russia, along with US crude supplies at 41-year lows. And we can just see that in the price action today. We got up to over $91 a barrel, and we just seem to be making higher highs and higher lows almost every day. And this thing is showing no signs of slowing down, and we very well could see $100 a barrel soon. And that's going to keep upward pressure on inflation, along with a bit of a squeeze on consumer discretionary spending at a time when student interest loan repayments are starting back up as well for over 40 million people. And we can see in government bond yields of the 2-year holding over 5.03% today, and the 10-year trading pretty firm here as well, 4.33%. And just flicking on my trend candles indicator, you can see we are in a well-defined clear uptrend in rates, and that's a strong headwind for other yielding assets like growth stocks. And we can see that show up in the spread of growth versus value stocks. Like I've been saying now, we might be putting in a bit of a double top on this on the daily chart, and just taking you out to a clean weekly chart, you can see that double top formation potentially forming after we've had a huge rip up this year in growth versus value. And if rates keep climbing higher, that's going to put a lot of downward pressure on this spread, because typically growth stocks are considered long duration assets, and that's really sensitive to changes in interest rates, and value stocks should perform better in a high rate environment. Over to economic data today, we had the inflation rate come out of France, a little bit higher than expected, 4.9%. Italy came in a little lower than expected, but they've still got inflation over 5% as well. much the same as the rest of the Eurozone, with a lot of their growth rates below 1%. Over to the States, we had some manufacturing and industrial production data come in today, and that came in a bit better than expected, with industrial production growing 0.4% month over month, above expectations, and same with year over year as well. But we did see the consumer sentiment survey come in a little lower than expected, 67.7. And that's probably got to do with the increase in oil, likely affecting consumer sentiment already. Looking out the next week, we've got a slow start to the week. Got a bit of inflation CPI data coming out of the Eurozone, along with Canada. Some housing starts data from the States, and then getting into the Wednesday, the big one, the Federal Reserve interest rate decision. Consensus is that they're going to hold at 5.5%, and that's pretty much what Fed Fund futures are implying as well. 99% chance that they will hold, which I think will happen as well. It would be a huge surprise if the Fed did hike here. I don't think they will. And more importantly, we'll be paying attention to the language used by Jay Powell at his press conference 1:30 p.m. as that is what will move markets. The market will be looking for signs of him talking about going on pause, but I imagine he's just going to be doing much of the same as he's been doing this year and just pretty much kind of leaving the door open and saying he's just going to keep watching inflation data and the jobs market. But if the market detects a slightly more dovish tone, that could help the stock market. I would expect that to help the stock market. We'll have to wait and see the price action reaction, because as it stands now, Fed Fund futures are only given about a 1 in 3 chance we'll get a hike by Christmas this year. So they're pretty much saying the Fed is likely to be done. Fear and greed index still in the neutral zone, and nothing too noteworthy going on in corporate insider transactions. Let's look at my indicators on the S&P 500. Dark pool percentage still in the bearish zone here at 41.8%, even though the market had a pretty good fall today. And my S&P 500 oscillator still in the neutral zone at 52. And stick with me right through the end, as I'm going to come back to the S&P 500 and give you my final thoughts on it and today's price action, which was a bit interesting, and I think things may be changing here a little bit. However, we'll come back to this in a bit. Just moving forward through international stock indices, we can see Canada's TSX is back up at this big resistance zone. Same with the UK FTSE. Germany's DAX had a pretty good gap up in the Friday session. We already covered China's fall, and Japan and Australia fell back a little bit. Still in a bit of a sideways pattern here. There's the VIX perking up a little bit here today in a change for a Friday, finishing the day up 7.7% at 13.8, and we can see the VIX curve starting to flatten a little bit. That's the difference between up the front and out the back. However, overall, option dealers don't seem really worried about this market, and they're only demanding 2 percentage points over realized volatility for their implied volatilities, which is pretty low here. And we can see those put-call ratios still below 1, so there's not a whole lot of insurance buying going on now. We did see a bit of an uptick over the last week or two, and breadth took a bit of a turn for the worse after we got that pop-up yesterday. We've done a bit of a U-turn today, had a bit of a dip down, now only 44% of stocks above the 20-day average, and smack bang half of stocks above their long-term 200-day average. And there's those new lows versus new highs continuing to deteriorate. 87 new lows versus 28 new highs on the Nasdaq today. There's the growth versus defensive sector spread, also forming a double top here potentially, and high beta stocks already on the downtrend versus low volatility stocks. The indicator of global economic growth, copper versus gold, still tracking sideways here, and there's commodities versus stocks, now in a well-defined short-term uptrend. And we can see that in gold versus SP 500 looking to find a bottom here. Gold versus treasuries found a new all-time high today, and a nice little bounce up in international stocks versus American stocks. And there's the yield curves all back on the March higher. Inflation expectations still holding up strong, and those higher yields caused bond prices to dip again today. Here's TLT. Now just below $93 a unit, right in this support zone here, and we'll be looking for this to hold if the Fed is truly done on rate hikes. However, since there's going to be a lot of bond issuance over the next year, both from Treasury and corporates, that's likely to keep downside pressure on bonds and upside pressure on yields, as a lot of the issuers will have to offer high yields to compete for the same capital. But high yield bonds are showing no signs of stress, still in this sideways holding pattern, and those higher yields are helping to keep a firm bid in the dollar. It's just sitting under 105 in the index. There's Bitcoin having a 4th day bounce off the support zone, and the commodity complex just having a little bit of a breather here today. But gold actually traded up a little bit, sitting right at its 50-day VWAP as it's been in a sideways pattern as well. And there's uranium ripping up again today. And we're getting a little bit technically extended here. We can see that in a bit of a shooting star candlestick formation. Indicators showing that pretty overbought as well. And over to stock sector there was only 2 sectors that finished the day high, and that was gold miners, closing up above the 50 on volume, and none other than the cannabis ETF, MSOS. Did a huge gap up today, almost reached $10 a unit, then closed a bit lower, but still finished the day up over 1%, and it's actually trading up here as I speak, 1.43%. And the worst performing sector today was semiconductors, down over 3%, and that's not what you want to see just after we got the IPO yesterday of a huge chip maker. And like I've been talking about, this sector continues to put in this big massive bearish divergence we can see here. And I'll take you to a medium-term 3-day chart. You can see that bearish divergence forming on my DSI as we've stalled out in this resistance zone, and that was from the all-time highs made back in late 2021. And as you can just see on this chart, the market definitely has room for a bit of a pullback off those October lows, and if we did get a 50% retracement, that would take us down to 121 on the semiconductor ETF. Same with the tech sector fund XLK. You can see a similar pattern forming on this divergence. It's kind of fading away from these highs. IPO sector is not getting too excited, still a bit off its highs, and a bit of a turn down on discretionary stocks. Retail still pretty weak, and one of the best performing sectors this year, home builders, now in a short-term downtrend, and along with a few others like Jets as well, which had been a good performer. And the best performing sectors of late, energy, did look to be getting a bit technically overextended here. We can see some reversal signals firing off, so we may get a bit of a pullback. And we got a little bit of a dip in healthcare and staples today and utilities, but we have had that good bounce over the last 2 weeks in utilities. And that's that bit of a defensive rotation going on in the market. There's the BlackRock barometer finishing down today on volume. There's JP Morgan and Apple, which I've been following a lot lately, seems to have held this support zone, had a bit of a buy the dip here, and was actually the best performing mega cap tech today, only down 0.42%. And this is a big key level we'll be watching again next week to see whether the biggest stock in the market can hold that. But the second biggest stock, Microsoft, didn't have a good day, down 2.5%, along with Amazon, and there's Nvidia falling 3.7%. And this really important stock, being the leader of the market this year, could be turning. We can see it's definitely stalled out. We'd had that big gap up after earnings, and then we've had CEO Jensen Huang now offload almost $100 million worth of stock in the last couple of weeks. Doesn't really give the market a whole lot of confidence. And just taking you out to a weekly chart here, what a run it's been on since October last year. And this has every reason to do a bit of a pullback here. And who knows, we could be back in the 300s any week now. Tesla seems to be holding up okay, and a bit of a bearish candle there in Meta. There's AMD in a well-defined short-term downtrend. And we got a good earnings out of Adobe yesterday afternoon. However, the market finished down 4.2% today. That was after Oracle's weak earnings on Monday. However, that seems to have held a bit. And just looking at another leading stock this year, Supermicro Computer, under ticker SMCI, have been on an absolute tear this year. That looks to have changed as well after their earnings. Bit of a gap down that's been defended, and then a further weak candle here today, down almost 8%. Over to the meme space, was a bit mixed out there, overall red. Active today was Planet Fitness, with announcing their CEOs departing. The market really didn't like that, down 15.9%. And there's a further bounce up in AT&T, and overall the banks were a bit weak today as well. Had some negative news come out of Charles Schwab that their assets under management have gone down a bit. However, there was a bit of a dip buy on this immediate term support here. Okay, so back to the S&P 500. It was triple witching today, and what that means is it's the third Friday of September, and that means we've got stock index futures expired, stock index options expired, and then the regular monthly stock options expire, which they do every third Friday of the month. So that triple witching can cause a lot of volume. That's probably why we did see a lot of volume today. However, there was a big change from yesterday's candle, because yesterday we gapped up on volume. It looks like it could easily keep going. We can come back up and test these July highs from that big bearish engulfing candle. However, this is a big U-turn today in price action. Gap down lower, held and finished on its lows, and we can see that across the board. There's a bit of bearish breadth, and like I showed with that trend, especially in Nasdaq stocks making new lows versus new highs, and the growth versus value spread starting to stall out, and high beta versus low volatility stocks kind of doing the same thing. Not to mention the firmness in government bond yields as well. That's a headwind for stocks. Let's not forget oil, the pressure that will be adding on to the consumer and rates as well. However, counteracting that is credit spreads, which are really holding up well. High yield bonds been performing better than treasuries for most of this year, and option dealers not all that worried with the VIX at 13.8 and only 2 points of volatility risk premium. So the market is still pretty calm here with its pricing on upcoming volatility and the credit market as well. However, like I said, that price action on the S&P 500 today could get things changing, and just taking you out to a medium-term 3-day chart, we can see that stalling out, some bearish divergences forming, and same with the Nasdaq as well. And things are even weaker when you look at the S&P 500 equal weight and the Nasdaq equal weight, along with mid caps, small caps, and micro caps. They're all in a well-defined short-term downtrend. So we'll see what Wednesday brings us with the Fed interest rate decision. The Fed's highly likely to stay on pause, but what the market will be really looking forward to is the Fed language. And if Jay did start hinting that he could be done a bit more so, then maybe that helps support the stock market. Otherwise, if he brings a spotlight on oil and how energy and food prices are staying elevated, that might further upset the stock market, and we may lose that key support on Apple. And who knows, Nvidia could be close to breaking down as well I can imagine there's still a lot of hot money in this that will all rush to hit the exit door at once. Once we do get that big 7, 8, 10% down day, that'll probably change things really quickly if that were to happen. And then we'll look back again and say, well, Jensen Huang was right. He nailed the top again, offloaded onto the market just after he hyped things up really good. So stay tuned into Click Capital and I'll keep you updated every day with what's going on. And like always, we'll follow the price action for clues and just see what happens. So that's it for this week. Thanks very much for tuning in. And just as a final reminder, this is your last chance to get all my custom indicators for TradingView for the one-time fee of $237. That includes all future access to any other indicator I develop free of charge. And like I said, if you're not really sure if they're for you or not, just test them out for 7 days. And if they're not for you, no worries at all. We'll issue a full money back refund. All you got to do is send an email to us. However, like I said, I use these indicators every day to manage all my own portfolios. That's why I've developed them, and I'm really proud to share them with you guys, and I've had a great response so far. So thank you to everyone who's joined. Truly appreciate your business. I look forward to bringing you even more cool stuff in the near future. So if you want to take advantage of this deal, click the link below the video in this description. And within a few hours from now, you can have these indicators in your TradingView account and looking for opportunities as well. All right, guys, have a great weekend, and I'll see you again Monday afternoon. Cheers.